Hello everyone. This is going to be a quick video as a beginner's guide to options trading. So let's get started and we'll go through an example too so you can see me put one of these trades on. So what are options? Well, it's quite simple. It's just a contract between a buyer and a seller regarding an underlying stock. What is underlying stock? Well, think if I'm buying a call in Microsoft. The underlying is the Microsoft shares, the Microsoft stock, right? So there are two types of options, calls and puts. A call is a long or bullish expression of a trade. We want the price of the underlying to go up. The put is simply the opposite of that. You're short, you're bearish. You want the underlying price to go down. So how do they work? Well, first of all, each option contract is it represents 100 shares of the underlying stock. There are two primary components you need to understand before putting on a trade. That is the strike price. That's the price we want the underlying to get to by an expiration date. So if you get your head wrapped around strike price, where we want the price of the underlying to go, and the expiration date, the expiry, this is when the contract expires, and we need the price to be at or near that strike price by the expiration date. So why stock options? Why not just buy stock? Well, leverage is number one. Using Microsoft as an example, which is currently trading at about $410, if you were to buy 100 shares, that would cost you $41,000. But I can control those same 100 shares for a fraction of the price, let's say around $1,000. And we'll actually use Microsoft as an example so you can see that. Flexibility. Once you really master options, building a portfolio, you can use these things to do all sorts of things to express an idea around your portfolio. Say you hold that Microsoft stock, $40,000 worth. Well, how can we use options to make money with those shares? How can we put on leverage to also amp up our returns on the shares using calls or puts? Then, like I mentioned, there's a buyer of an option and there's a seller of an option. So on the selling side of calls, people are looking to make income. So they're the seller of that option, that call contract, and we are the buyer of that call contract. So how do we place an options trade? Well, first of all, every broker on planet Earth has effectively the same user interface to look at trading an option. So here we're looking at Thinkorswim, which is a Charles Schwab product. So we're on the Microsoft weekly chart. So step one of buying a call, and we're bullish with a call, right? So we want the price of Microsoft to go up. Step one, let's look at the chart and let's understand the level of price that we're trying to work within. So right off the bat, what I like to do is just establish a range, put in my head uh, where a low end and a high end of range is. Now on Microsoft, that's quite easy. Look at this channel that's been forming from around $400 at the low end to about $450 on the top end. So there's our channel for Microsoft for the last couple months, right? So this goes back to the beginning of 2024. So we're looking at a range of about $400 to the top end of about $450. So that's going to be critical and important when we look at the options. So let's go over to the options now. Here is the option chain for Microsoft. Here are our expiration dates on the left. We can see starting at 7th of February, so that's this Friday of 2025, all the way out to the 17th of December 2027. So we have a lot of expiration dates to work within. Now remember, our channel on the chart, $400 on the low, $450 on the top. So if we're bullish and we want to keep this simple, we want to get a strike around $450. And then let's look at the time component of that. So if this is going to work in our favor, we basically want Microsoft's chart to do something like this. Get us to the top of that range, right? Let's look back at the option chain. Okay, so here's our expiration dates. Now let's expand one of them. Let's go out into 15th of August, 2025. You can see we've got a long list of strike prices. At the bottom, $200. At the very top, $660. Now, you can limit the number of strikes you see. You can see I've prepackaged in Thinkorswim. I can just see 14. That makes it a little simpler to read. You can see at the top of the range now is my 450 strike. At the bottom is the 385. Now going over here on the left side, these are the calls for the strikes from 450 at the top, remember, to 385. Here's the bid. Those are the people bidding to buy. And here's the ask. These are people selling. So they're asking for a price and then they're bidding for a price. Two other columns I want to talk about real quickly. And you might need to add these into your display if you don't see them by default. But mark my words, these do exist in every broker platform. So open interest. This is the number of contracts currently open. There's also volume. So just like trading stock with volume, right? It's how many shares have traded that day. In this case, these are the number of contracts that have traded this day for Microsoft on this strike on this expiration date of 15th August for these strikes. So 141 contracts have been traded today for the 445 strike for the 15th August 25 expiration, right? So currently 450 is being bid for $17.75. So quick math, 1775 times 100 shares, right? Remember, each contract's 100 shares. So that means this is going to cost us about $17,000, right? So to buy this, we can join in on the bid by clicking the ask 1795. It brings up a window where we can configure our trade. We're going to buy. In this case, it's saying 10. I don't want 10. That would be $17,000. So we just want $1,700 with one Microsoft 15th August 25 450 strike. It's a call, and we're going to put the bid in at lower than the ask. So let's go down to 1760. Okay, now we can click confirm and send. It's going to bring up this little confirm window, and you can see a summary of the order. In this case, my 1760 per contract translates to $1,760 for one contract. My max profit is infinite. My max loss, what's that? Well, it's just the $1,760. So if something bad happens in the market or something like that, Microsoft plunges, they have an earnings report or something like that, right? My max loss, let's say they go to zero. $1,760 is my max loss. That's the beauty of the options. You know a very clearly defined risk. So I can enter this trade and know I'm putting on $1,760 of risk. So if I want to put this order in, and let's go ahead and do it, we're going to click send. Okay, now I've got the bid out there. You can see they're trading right now at 1765. So I put it in at 1760. So if that hits, I'm going to purchase this contract, right? Let's go back to our chart and just talk through what could happen here. So let's say Microsoft earnings, which are on 4/22, right? So that's April 22nd of 2025. That causes the price to spike. And remember, I've got till August, right? And it goes to this 450. Well, let's look at that option chain again, just as an example. So the at the money, which is about, well, let's say, so Microsoft's currently $414.77, right? So the in the money, that's in the money calls are the 410s, right? So kind of right at the money are the 415s. Those are going for 33. That's almost a double from my current entry point of 1765. So just play it out in your head. Let's say next week or the week after, for some reason, Microsoft spikes and it gets closer to that 450. Well, here's just a quick range I can do in my head. I'm almost getting a double on these if we get closer to that 450, right? Which brings it at the money. So you can see the advantage of options here, right? So $1,700, I'm controlling $40,000 worth of Microsoft stock. And if we get closer to that strike, I'm going to double my money. You're not going to do that with shares of Microsoft stock, right? But you can do that with calls. Let's go back to the slides quick and finish off these last few and talk through another few other things you want to look through. But in summary, in your broker app, you know what? Before we do that, let me just give you a quick summary. So, first thing to do, understand the price levels because you're going to be buying an expiration and a strike for your call, right? So we want to understand, is it feasible that the price of Microsoft in this case gets to that strike by my expiration day? My expiration day is over here in August, okay? So here's my hard cutoff. So I need Microsoft to get up to this 450 level or at the very least increase. If Microsoft increases even just to up to the halfway point, let's say 430, this call is going to be more valuable than the 1750 I just paid for it, right? So I could just game it this way. I don't need to get to that strike and get it in the money. I just need Microsoft to go up. And because there's a time component to this, what's the feasibility of it getting to that strike as we move forward, right? So if Microsoft just stays level all the way into July, the chance of me getting up to the 450 is very slim. That means my option price is going to decay over time. So there's a decaying time component to option pricing. The closer we get to that cutoff date and the farther we are away from price, the lower the price of the option is going to be at, right? So we want to combine these things, that strike, that expiration, looking at the chart and thinking about the feasibility. You can keep it that simple. You can trade and make money with calls just doing exactly what I showed you. Don't get more complex than that if you don't want to. You can stay there and make money doing exactly this. So now let's go back to the slides. So risk and considerations. Yes, options are complex. I just showed you a bare bones example, one that I have used for 15 years and made great money with. You don't need to get more complex than this. And we have a well-defined risk. It's what I paid for that contract, right? My worst case scenario is that it goes to zero. Time decay. This is also something that's critical to understand, right? There's an expiration date to these and a strike date. Well, time decay implies that the price of the option is going to decay the less feasible it is that we get to that strike price by the expiration date. Volatility is another thing to think about. What if Microsoft spikes 10% next week? That's pretty volatile, right? Well, my option is going to be much closer to that 450. In fact, it'll almost be at the money. So high volatility is going to bring me those profits much faster. If Microsoft's in stasis for the next 2 months, not much volatility, then that option is going to have time decay, right? And it's going to go down. So you want to understand time decay, and you want to understand the role of volatility in pricing these options. So understand those risks before you get involved, know the chart, and then just go for a strike that makes sense. If you buy a call on a down day in the stock, you can pay less for time and you can pay less for a lower strike, right? So that gets you closer to at the money faster. So buy these things when Microsoft's down. If you buy it on a big up day, say Microsoft's up 3 or 4 or 5%, you're paying now more for those calls. So you can time this out and game it out as to when you enter these trades to maximize profit and minimize risk. So conclusion, these are powerful tools. You can use a small amount of money to control a whole bunch of stock. You can practice paper trading. Now, I don't find much value in that because you remove the money component where you have money on the line to trading, and you remove the most important factor, which is psychology. Psychology is what plays against you. Use a trusted platform. Outside of the United States, things like Interactive Brokers, Tasty Trade. I think Charles Schwab works internationally as well. That's what I just showed you with Thinkorswim. But use a good, trusted platform. Continue learning. You're always going to be evolving and growing your skills. But if you just start with what I just showed you, you're going to be on your way to making profits with some good decision making, understanding the chart. And then continue following us. In Trade Canary, you can go to a company like Microsoft and see what their put call skew is with how much money is being put down on the calls and how much they are on the puts in a nice, easy to read chart. So you can kind of gauge how much money is going into certain strike prices by expiration dates. Very helpful to visualize that. So thanks for watching, and we'll catch you on the next one.